Good morning, ARMR Insiders. Welcome to the morning meeting. Soak up that AMRK chart pattern and success. We're going to get to that in a minute. We're going to go over why we're making money there, why the portfolio, ARMR Special Situations Fund, was up yesterday with the market getting whacked. It's a specific style of putting capital to work, marrying fundamental research with the correct entry point and algorithms. Those three things together is what creates success. We're going to go over that today, how we do it. Of course, we're going to start with the risk monitor macro picture. What happened to the market yesterday? What may happen to the risk monitor by the end of the week and changes we might have to make. So we're going to go over all that. We'll wrap up with the discussion of the ARMR carry portfolio and how we traded yesterday. So we'll cover all those bases. I'll take any questions you may have. Go ahead and fill them up in the comment section of this video, and I'm happy to answer it now or later. If you watch this later, I'll answer during the day. Of course, ARMR Insiders, you can always fill up the Slack room, and we'll talk in there. So before I hop in, don't forget, this is a virtual hedge fund experience. We're running 4 different funds: ARMR Carry, ARMR Macro, ARMR Special Situations, ARMR Dividend. You're the portfolio manager on your own desk. So you're taking all this information, figuring out what your strategy is, building a portfolio that fits your risk tolerance and your goals. And at the end of the day, you have to be the smart money. Okay. So risk monitor. Risk monitor has 10 indexes in it. We use the risk monitor to direct our investment strategy. When the risk monitor's green, we put most of our capital to work. We try to get all of that risk on closest to the stop. Then we monitor those 10 positions using algorithms. And when we see confluence, in other words, something that's happening across all 10, it will change the monitor color. So we'll get to AMRK in a minute. Let's go look at the NASDAQ 100. So what we're looking at here is the November green box. Every index, all 10, told us it was time to put money to work. The only animal that can create that movement are institutional flows of capital. And we have an axiom on this desk: information makes money, institutions make markets. Information makes money, institutions make markets. Okay. So we focus heavily on institutional flows, and we use our risk monitor for that information, and it helps us manage risk. So in the green box, we're getting long. And now the question is, will the risk monitor turn red? There's a possibility of a yellow, but let's don't talk about right now. Let's just focus on green and red, right? If it goes red, we have to get much more defensive. So what would change it red? Let's just go through every index today. Okay, let's start with, out of the 10 indexes, 4 have turned red. What are the 4? The Dow went negative yesterday. That turned red. Small caps went negative. That turned red. Value, which very much kind of mimics small caps, value turned red. And treasuries. Treasuries turned red. Okay, so of the 10 indexes, those 4 went red. Is it enough to change the risk monitor to yellow or red today? And the answer is no. Let me show you why. The strongest indexes that have been driving this market rally, let's start with momentum. That's the strongest. Momentum has been the strongest. Momentum is still in this consolidation. It has not closed below the low of last week. ARMR Algo is still long momentum. That's the strongest index. Small caps have been the weakest index. Okay. So it's not a surprise small caps are breaking down, but what's been driving the market have been momentum stocks. Let's go look at the NASDAQ 100, right? Momentum stocks. The NASDAQ 100 is still long. Equally weighted NASDAQ 100 held on yesterday. It's close, but it held on yesterday. That's the equally weighted technology sector. The S&P weighted, still long. The S&P equally weighted, held on just barely, but it did it. So what I submit to you right now, and by the way, the IBD 50 is another index that held on. That's our other index. Okay. So what I submit to you right now is the strongest indexes that have been driving the rally that we've captured since last November are still long in the ARMR Algo risk monitor. So what's fallen off that's concerned me is the Dow. Okay, that's a bit concerning. And we highlighted this last week. We said, God, the Dow looks pretty awful. That's a problem. And treasuries. So now let's get to treasuries. Okay, treasuries breaking down. Okay, yesterday the CPI number was hotter than expected. This morning, we get the PPI number that's weaker than expected. Everybody run this way. Everybody run this way this morning. PPI is weaker than expected. Yesterday, total panic. CPI is hotter than expected. None of that information should be considered when you're trying to manage an investment portfolio. It means nothing. Nothing. Wait another few minutes and there'll be another economic number comes out. Everybody run that way. That's not a way to run money. Institutional flows of capital. Information makes money. Institutions make markets. Where are the flows of capital? Forget about all the other noise. Okay. Bonds look terrible after yesterday. They've been weakening. This is a market that's telling us it's concerned that the Fed can't cut rates. I'm not going to debate that with you today. I could argue both sides of that coin. I would submit to you that if we listen to what Chairman Powell said at the last meeting, 1 or 2 data points doesn't change the fact that they're going to be cutting rates this year. That's what he said. He said point blank that they expect inflation to be hotter in the beginning of the year and weaker in the back half of the year. If there's going to be any rate cuts, it'll be in the back half of the year. The rest of this is washing machine noise that should have nothing to do with managing a portfolio. Okay. When it comes to bonds, I don't like how they look. I'm with you. And I say to you constantly, I'm the author of the comment constantly that bonds lead stocks. So I don't like the TLT look. I don't like what's going on in high yield debt. That's a breakdown of the pattern. Remember, we were talking about that pattern. That's ugly. This is corporate investment grade. Doesn't get worse than that, right? They're just all breaking down. That does not look good. This is why the risk monitor is hanging in the balance right now. The bond market gets worse, probably tips institutions into raising more cash, and we'll see that come through the algo, and the risk monitor will get red and we'll raise more cash. But we're not there yet. Bonds have a tendency to move in a different fashion than stocks, and I think it's incredibly important to look at weekly closes before making bond proclamations. You could say that's true about stocks as well, but it's definitely true about bonds. So let's see where we are Friday. To wrap up this discussion on the risk monitor and the market itself, it hangs in the balance, but it's yet to move to a point where we have to raise more cash. Friday's close will be key. So I'll see you guys all day today, all day tomorrow. Then we'll make our decisions if things change. What will we have to do to change our portfolio? Not much. Not much. So now let's talk about the highlighted stock of the day, group of the day. I'm going to call it highlighted investment strategy of the day. And that's how the ARMR Investing Way puts money to work. Our primary fund for individual stocks, called our ARMR Special Situations Fund, was up yesterday as the market was getting wrecked. How did we do that? Well, we shifted our focus to commodities starting in late February. Okay, take a look. What are we long in our portfolio? We're long silver in that green box. That's late February. We're long gold in the green box with the arrows, late February. We're long the mining stocks, late February. We're long FTI, say it with me now, late February. Tidewater, late February. We've built up exposure in things like EQT in March, HP, drilling stocks in March. So we started late February in commodities, and then we've looked for more commodity investment late March back on the uranium trade. So what I submit to you today is that our job as portfolio managers is to go where the puck is going to be, not where the puck is, to use a hockey term. We need to go to the ice where the puck is going to be, not where the puck is. Our job, and the way we do it on this desk, is to build our whiteboard of fundamental ideas. These are companies we want to own. Then we look to buy weakness in the midst of strength, and we use algos to show us when that strength is going to reemerge. We want to buy as close to the stop as possible. And when the stock is breaking out of the traditional breakout and all the momentum guys come in, we're going to let them mark up our portfolio. And that's how you make money yesterday when the market's going down big. Capital shifting into commodities. You want to already be there. And as it shifts like that on a day like yesterday, we just sit back, relax, and enjoy the show. Let's look at the poster, the centerfold of the portfolio right now. That's AMRK. We talked about AMRK last week. This is a perfect example of how we like to execute. AMRK's been on our list for years. ARMR analyst Silver Fox loves this idea. whenever we get long precious metals. This is a place to go once they take off. Notice I'm not buying this. I could have late February. I could have bought it in here, okay, when we were buying precious metals. But we start, when it comes to buying precious metals, this is a bit of an aside here. When we buy precious metals, we layer it in. We start physical. When we get paid there, we're buying big cap miners. We get paid there, we're buying small cap miners. We get paid there, and we start looking for special situations like AMRK, right? And what we're doing is looking for the ARMR algo. I was actually a tad bit late last week. Should have bought it a little bit earlier. You know, this green box should be down here. The algo was giving us the long signal right in here, and I was a little more aggressive and paid up for it a little bit. And then we had the rip higher. Okay, that's the entry point we're looking for. Look at CCJ. This is a perfect example. We've been trading, uranium on and off this whole rally. It gets ahead of itself up here. We don't own it. It sells off for 3 months, tests the uptrend, algo buy trigger, breaks the downtrend, starts to move. When this thing makes a new high and everybody else comes in because now the momentum players are there, we're going to let them mark up our portfolio. We're not going to chase that. You want to buy weakness in the midst of strength, top day strength, using an algorithm to tell you when is the probability at its highest and reward versus risk is the best, optimal. That's when you put the money to work. Some positions hit the stops. We know that. Stops are tight. The other positions pop, and that's how your net worth goes up. And so what I submit to you now, and I'm going to answer a question. An ARMR Insider asked this question. What do I think of this stock now? Let's apply ERX as an example. What do I think of ERX now? Because we were talking about it here. Okay, this was the time to buy ERX, and we were talking about it on our desk. Okay, and you could either buy ERX or you could go out there and buy, FTI and, Tidewater. It was the same thing. We decided to put the money in FTI and Tidewater and some of our individual names, or you could own ERX. And we talked about it down here. And I know some ARMR insiders own ERX because you like the ETF better. And I get it. I do too sometimes. It's just really a preference. But your question today is, can we buy it up here? And after everything I just said, I think you can answer that question now. I think you can be the smart money now. Look at that chart and tell me if you think we should be buying ERX now. You don't have to answer. Do it on your own. I know you know the answer. We want to buy weakness in the midst of strength, top day strength. We want the algo to give us a buy trigger. Okay. That was the uptrend. That was the pullback. That was the entry with the algo. This is the markup period. Do we want to be the sucker who marks up the portfolio? And I say that, I don't mean to be mean, but you know what I'm saying? Like, look, you could put money to work on a breakout. People do that all the time. Asset comes across tops and people mark it up. You can definitely make money that way. So I take back the sucker thing. I take that back. Okay. Because I've been a momentum guy my whole life. And you'll see me every now and then go out there and buy momentum. But the reward versus the risk at this stage is not optimal. You can go do whatever you want to do, but the puck's already there. And so if I'm going to add something new to my portfolio, I want to go somewhere where the puck's going to be. Find me positions that look like ERX here. Okay. What positions look like that right now? That's what should be at the top of our whiteboard so that we can capture that. And hey, let me tell you something. If you can't find ideas to put at the top of your whiteboard, I call it the top shelf, another hockey term, right? If you can't find names, you say to me, well, I can't find anything that looks like that right now. Then stop investing. What's that telling you? It's telling you the market is overstretched. Enjoy the money you're making and work on risk management instead of worrying about what's the next idea to buy. We'll work on it today. We'll work on it on the desk today. I'm going to go through a lot of charts with you guys. ARMR Insiders, we'll get that started at 9:30. Okay. I'm going to go through a lot of charts so we can build our whiteboard. If this market goes higher in here, which it may, I have cash in the portfolio. Where do I want to put that cash? I don't think it's going to be commodities. That decision was late February and we added to it through March. We earned the right to do that. It's not now. That's all those positions are done. I don't want more commodity. I want to know where the puck's going to move. So we're going to go through all of our charts and then build a list of the top names where we see weakness in the midst of strength. And we're looking now for that algo buy trigger. I imagine there'll be a bunch of technology names that have gotten whacked right down to uptrends that'll start to look interesting. All right. So Those are my thoughts for today. We covered macro, big picture, risk monitor. It goes red by the end of the week. We raise more cash. Our commodity positions will not be affected by the risk monitor. We're going to manage them separately following stops. Whenever we get stopped out of those positions, we'll get stopped out. Our index positions would go to cash. We have a core index holding now. Risk monitor goes red, bang, that'll go to cash 100%. Okay. But at the same time, if the market holds up here, closes the week stronger, this is just a perfect consolidation and test of the uptrend that started last November. And if it holds and reverses higher, we're going to want to load up on our tech names that have been beaten up. So that's the list we want to build. Because if we start getting buy traders using the algo and risk monitor's green and we break out again, that's where we're going to go to fill up our portfolio, get some balance. We have our commodity and we'll have some balance. All right. So let's wrap up real quick.